This is another example of how to do closing entries. This time we're going to have a net loss instead of a net income. Now, remember, when you do closing entries, you're closing the temporary or nominal accounts, which is everything that is after capital in your general ledger. So capital will not be closed, it will be updated, but drawing, revenue, and expenses will go down to zero, and we will use the income summary account to help us do this. When you want to do something to an account, it first has to go in the general ledger. So just keeping in mind what we've got here, and if you think of read, revenue, expenses, income summary, drawing, we're going to do it in that order. Notice on all these accounts that I have showing that they all have plus and minus sides, like capital is minus plus, drawing is plus minus, revenue is minus plus, expenses are plus minus. But when it comes to income summary, this is an account that does have a debit and credit side, but it does not have a plus and minus side. Okay? So what we end up with is the total expenses on the debit side and the total revenue on the credit side. That's what we're going to be ending up with. If we concentrate first on the revenue account, and revenue has a credit balance of $4,000, we would go to a general journal page and we would write closing entries. Make this a little bigger here for you. And we'll just make up a month. We'll say it's for the month of September, because this is what the weather looks like, doesn't it? Okay, September 30th. And the name of our account is income from services. So we're going to debit income from services. And I'm just looking at it again. It had a balance of $4,000, so we have to debit it for $4,000. And we're going to transfer it to the income summary account. Don't need the word account there, and there's 4,000. Okay, so that's our equal debit and credit. Next thing we want to do is close out all of the expense accounts, and we're going to do that also on the 30th, and we're going to be moving them into the income summary account. And as you go back and look at the first page, we have advertising, supplies, and wages. Those are the three accounts we need to close out. So we're going to credit advertising expense, and the balance of that was $500, so we have to credit that. We're going to close supplies expense, and that is for $700. And we're also going to close wages expense, and that is for $3,000. Okay, now that we know what these three are here, then we know what our debit up here will be, because this debit equals the sum of these three. So if we add these two together, our total expenses are $4,200. The debit equals the sum of the three credits. Looking at this right now, Big Al might be tough, but he's not making a net income this month because his expenses exceed his revenue by $200. So he has a net loss. That net loss is going to decrease his capital. So when we close the income summary account, we're going to be debiting the capital account for $200 because the net loss is decreasing it, and we're going to credit income summary for $200. So if you remember what happened to Big Bird, the first two entries are the same. Close revenue, close expenses. But when you have a net income, income summary comes before capital because capital is getting bigger. When you have a net loss, when you debit capital, it makes it get smaller. So these two are flip-flopped when you have a net loss. The fourth one is when we close drawing. And drawing, if you're going to close drawing with the debit balance, you credit it, and we're debiting capital. And the amount of the draw was $2,000. And we're crediting drawing to make it go down to 0. Okay, so remember this number here is always the difference between your revenue and your expenses. When you have a net loss, though, you're going to debit capital. When you have a net income, you're going to credit capital. So these are the ones that would reverse. Okay, I'm going to go back and put these in the accounts now. So if we debited income from services for $4,000, we would put this here. And now looking at this, these two match, so they're closed. And we would go to income summary and put that $4,000 over here. Stick a comma in there just to make it more readable. And then if we do the second entry, we would go to income summary and we would debit it for $4,200, which is the amount of our expenses, and then we would go to each expense and we would credit them. And in doing so, then the accounts go down to 0. And that's exactly what you want. Third, we want to close the income summary account. If you subtract the smaller from the larger side, we have a debit balance of $200. So we're going to have to credit income summary, and that's exactly what we did on that general journal page over here. See how we had credit to income summary to close it, and we moved the balance and net loss into capital on the minus side. So here we go. Capital is going to go down by 200. That's the amount of the draw. And income summary, we're going to credit it for 200. And now if we do that, this is going to have a footing over here of 4,200. So 4,200. Let me make that a little bigger here. Okay, so this number here, they're the same, so that account is closed. Capital is not closed, and remember, we don't want to close it. We want to bring it up to date. The last thing that we had in our journal was that we debited capital for the amount of the draw, and we credited the drawing account. So here's the capital account with the drawing getting moved in. If we foot this now, we have 2,200 over here. Okay, and then if we go down here and put in this credit to drawing, we've closed this account out. If we subtract 2,200 from 10,000, I believe we have a balance of 7,800. And so this account is not closed, it's brought up to date, which is exactly what we want. The other accounts in yellow are closed. And that concludes this video of a business with a net loss.